Hi, my name is Siddiq Adesha, Chief Investment Officer for Sun Life Global Investments. As we begin to settle into a new normal, the markets are still showing a lot of uncertainty. In March, we saw the CBOE volatility index levels go above 80, about 4 times the long-term average. Heading into June, the VIX has settled into the 20s and 30s, still significantly above normal, but for now, down from the extreme. As we move into the next phases of the pandemic, we continue to manage risk while looking for opportunities for longer-term growth. Join us as we present our Quick Take series. At Sun Life Global Investments, we go through a rigorous process to select and monitor sub-advisors from around the world. In our Quick Takes conversations, they provide important insights into their regions or asset classes. We hope that this diverse coverage will help you manage and stay informed through this period.
Hello, thank you for joining us today as we speak with investment specialist Peter Loncto to discuss the Sun Life MFS International Opportunities Fund. Peter, how has the market been impacted by the recent event?
The market impact of the coronavirus has been the dominant market story of 2020, as efforts to slow the spread of the virus brought economic activity to a halt in many industries and led to sharp declines in employment and economic growth across the world. Before they rebounded sharply, international equity markets, as measured by the MSCI EAFE index, fell about 20% in local currency terms. The speed of the fall was unprecedented and volatility hit record levels. In response, central banks around the world implemented substantial monetary and fiscal stimulus to inject liquidity into the markets and provide financial support to small businesses and consumers. Encouragement about the response from central banks and policymakers, combined with optimism about a potential vaccine or therapeutic, have underpinned a swift rebound, with the MSCI index now down about 11% through June 26th. Spending patterns by consumers and businesses have changed dramatically in response to the new environment. Growth stocks have dramatically outpaced value stocks, a trend which we've seen across all the major indexes in developed and emerging economies. That has been driven in large part by outperformance of a small group of growth companies that were ideally suited to the changed behaviors resulting from the shutdowns, things like increases in cloud-based computing and e-commerce, and companies whose products enable working from home as well as in-home consumption of entertainment. Many of these stocks had rather high valuations entering the year and have outperformed the overall market for the year-to-date period, leading to an even wider valuation gap between some of the larger high-growth stocks and the rest of the market overall.
Are there any sectors or regions where there could be opportunities given the recent market events or sell-off?
At the outset of the market sell-off, we struggled to find many dislocations in the market because stock correlations rose dramatically. That is to say that there wasn't much difference as most shares sold off dramatically. So in the initial stages of the market sell-off, we only made a handful of relatively small trades, and they generally fit the theme of upgrading the quality of the portfolio. While a number of stocks that were on our watch list became more attractively valued, we did have concerns around the balance sheets of some of these businesses and or the potential that they might face long-term demand destruction due to those changed spending patterns. And so that resulted in fewer trades than we might have otherwise made. One area we did add to was a couple of cyclically exposed businesses which sold off with the rest of the market. One is an industrial conglomerate whose more cyclical businesses were facing a downturn, but we believe the market was overly pessimistic on their other businesses, which have higher returns and are allocated most of the incremental capital. These businesses include robotics, factory automation, and medical electronics equipment. The other company is one of the leaders in automotive lamps. They have approximately 20% of the global market share. We believed the company was well positioned to benefit from the continued transition from halogen lamps to LED lamps. That company has very high barriers to entry, which are due to safety requirements and the complexity of its product's design. And that results in above average returns on capital and free cash flow generation. In thinking about structural changes in a post-COVID world, that also led us to initiate a position in an industrial company that has exposure to re-onshoring, as we believe many companies will consider new locations for their supply chains.
Have there been any changes to the fund based on your view?
Well, despite the heightened volatility of stocks this year, there have not been any material changes to our investment strategy or process. Although there is a lot of uncertainty, we continue to focus on the durability of the companies we invest in, and we always maintain a long-term perspective. Looking at how the fund sector exposures differ now versus at the beginning of the year, our exposure to the communication services sector, it's modestly higher now. That is due to a new position in a Chinese internet company, which we believe has a strong competitive position in gaming and messaging, and a significant pathway for growth of its chat and payments businesses. The fund is also modestly more exposed to the healthcare sector, as we have added to existing positions in a couple of European pharmaceutical stocks, which we believed had become cheap relative to their stable long-term growth prospects. And those were offset by slightly lower weighting to stocks in the consumer discretionary sector, where we sold out of a casual restaurant operator in China. At the time of the sale, the stock had performed in line with the market for the year-to-date period, despite what we believed would be a significant impact on earnings this year due to the coronavirus and the related shutdowns. And then we also had less confidence in their long-term growth prospects. But again, overall, no significant changes to the portfolio, and we continue to apply that long-term view to all of our investment decisions.
Thank you for your time, Peter.